Welcome to the Quant Room, the stories behind the data.
All right, welcome back to another episode 6 of the Quant Room, powered by Spikeet. And the purpose of the series is to gain knowledge and information from other traders who are, I guess, successful. We have a successful trader here today, but it's not always successful traders. We had a middle of the road trader, and we're just trying to gain information on people's journeys on a systematic route of trading and beating the market. Today I have a guest, and he's going to be a very unique guest. I don't know how many people we're going to be able to find like him. He does multiple styles of trading across multiple markets, global, US, futures, and he's very long biased, it seems. So I'm interested to getting to know his story and kind of getting the stories behind his data of his journey. So without further ado, Dan, how are you doing today?
Pretty good.
Yeah,
it's good.
Like
good day in the markets overnight, so pretty happy.
Okay, good day in the market. What were you looking at today?
Mostly silver, platinum, and the metals. So silver's like, I think it's doubled since I entered. It's entered around July.
Wow,
it's gone pretty crazy.
Man. Interesting enough, yeah, this has been one of the strongest themes, I think, of the year. That's probably silver, gold. Yeah, underrated theme so far. Okay, well, Dan, I would like to get started with my first question. I kind of want to get to know a little bit about your background. So, you live in Australia, but you trade markets all over the world. That's pretty interesting right there to start off with, right? So can you just tell me generally how you got started in trading?
Yeah, so I was mostly like investing. I did do some trading early on, shares and things like discretionary. It was like mostly luck originally. And then I bought some real estate. So I got into real estate quite a lot. Then I was working my career. I was working in tech. And sort of around COVID, probably similar story to most people, I eventually went full-time trading because I was in crypto at that time. So crypto, as you know, is pretty inefficient. So I was working out pretty well to do discretionary in crypto. So, but then crypto got real scammy, as you know it does. And I wanted to like, not just scammy, but it burns you out working 24 hours and ridiculous stuff.
Oh, because the 24-hour market and stuff?
That and the bull market, everything moves so fast. Like you see opportunities, and if you don't grab them, you're going to miss out. I mean, you're going to miss some opportunities, but there's just like crazy stuff happens in the bull market in crypto. So you have to.
That's actually that's pretty interesting. So you were like doing discretionary trading in crypto in 2020. It sounds like a little bit, and yeah, talk a little bit more about that 24 hours. I don't think that's from, I guess, us people who's trading like the US market mainly. We don't really have that experience. So can you briefly talk about like kind of that burnout there? That's an interesting perspective I haven't heard yet.
Yeah, I mean, especially from Australia, because even though it's 24 hours, a lot of the stuff happens in the US time zone. So yeah, at the moment, like US stock market opens at 1:30 a.m. here. So I was like getting up, sleeping during the day, waking up to check on things. And then I had a kid, so it's pretty intense.
Yeah, I can imagine that. Yeah. So how long have you been trading in general so far?
Full time since 2020. Then before that, when I was working, I was like on and off. So I did do crypto in 2016, 2017. But that was my first cycle. So you're right up like 700% gains, and then you lose like most of it in your first go.
Wow.
So
700% gains. That's a relatively large number. So
yeah,
that was
I didn't keep it.
Oh wow. I mean, still you got to experience it. I think that experience does amount to something. But 700% gains when you first started in 2016, or was that like 2016 through 2020?
It was 2016 into the 2017 bull market. 2016, I just bought a little bit of Bitcoin and was just holding it. And then 2017, they had the initial offerings. So you could buy all these altcoins, hold them. They were going up like 1,000% each kind of thing. And then once they start going down, because you're convinced you believe in the project and all that, you keep holding, thinking it's going to go back up. But of course it doesn't. And then 2018, everything's dead. So you kind of
that's kind of like the story that you had with the believing in the projects.
Yeah. So then my next cycle, I was pretty mercenary and just dumping stuff as soon as I
could. Okay. So I guess that explains kind of like the I guess the early approach to your trading. So when did you get, I guess, more systematic?
Not till 2024. So like middle of 2024, around April, I think, I got real test. So I was trying out like multi-charts and all the various things, but I sort of thought I needed intraday data at first. So I was like trying all this stuff. I was using TradingView, Pine Script and things. But once I tried real test, I realized I didn't actually need the intraday data.
Okay, nice. And I guess a lot of us believe that we need intraday data. So that's interesting. What made you believe that you need intraday data? Like, what was that belief based around?
Maybe because of starting on TradingView, using Pine Script, I just thought hourly bars were like another thing from daily bars, but daily bars have a lot more predictive capability for long-term trading, I think.
And makes sense.
I lean towards long-term because I want to be able to sleep through when my trades are.
Yeah. So would you say that part of your style of trading is dedicated to like the time zone that you're in and like your kind of like your lifestyle? Would you say that has a big influence on it?
Yeah, I think it's very personal. So if you're someone who loves to just sit there and watch the market, you could be discretionary. If you want to be able to sleep through it, do other things. Like I have this dream, I can just run my orders and go sit on the beach or go on holidays or whatever. And we are going on holidays soon, so I'm trying to keep it to just 10 minutes a day or something. But yeah.
10 minutes a day. Wow. That's that's the dream, man. 10 minutes a day. I kind of like trading though. But so just on a high level, how do you view the market? Like what is your belief on the market? And when I say the market, I mean you can talk about futures, you can talk about any market that you particularly have like a strong belief on. Like what is your general approach when you're trying to decide how you're going to build edge?
Yeah, it sort of changed over time. Like when you start discretionary trading, you're thinking about my entries, my exits, you're thinking about the individual trade. But now I sort of feel like the market makes money by itself. So I just have to have my positions. And as long as they're good positions in the testing, then the market will make money by itself. So like most of the biggest gains have come from old positions. The stuff that I was already in, like silver, I got into in July, and just being able to sit there and ignore it, basically, it then starts to make gains.
Okay, that's interesting. So, are you like responding to like more price behavior, or is it new structure in your systems? Like how is it? How is exactly that work for you when you're putting on the trades? Like what is your system responding to exactly?
Yeah, so it's mostly it started out as trend following. So what I started stops actually in April. Then I got into trend following more, and I used to trade futures a bit discretionary. So I changed my system to be futures trend following because I didn't like the high frequency of the stocks.
Okay.
So then futures trend following is much longer term, but the problem is the cycles are long as well. You could have like a whole losing year, 2 losing years. You could have to wait for quite a while. So you could focus on that, but since mid this year, I've been adding other systems. So my goal is to have a whole bunch of systems that can make money almost every month.
And so, okay, I understand what you're saying. So I guess my question here is the purpose of the systems to diversify, or is the purpose of the systems to I can find more edge and it's going to help me make more money? Or is it like, well, I have an edge here, maybe this is going to, when this is not being, not performing well, this is going to perform well? Like, what is the ideal behind like developing so many systems?
Yeah, I think that's it. So I think I don't look at like a specific system to be diversifying, but I build systems to try and make money first, and then if they're diversifying, then that's a good thing. And
Okay.
I won't know until I do a combination test. So I like build systems individually, see how it works, see how high the volatility is. Then I'll do a combination test and see what happens with the rest of the system.
Okay, that makes sense. So you're not like necessarily doing like portfolio level testing and trying to cover your weakness in your portfolio, or just building systems, and if it covers your portfolio, then great. That's kind of like the approach.
Yeah. I think it's kind of a different kind of curve fitting if you're like trying to build exactly for your portfolio, because you might pick something just because of a particular drawdown, and then you might change it to move the drawdown kind of thing. You know what I mean?
Yeah, that makes sense. Okay, so what do you believe actually creates what do you believe creates edge in the market? Right, you have systems across multiple markets, so I'm assuming, being a guy who's been able to create edge in so many markets, what is your approach to this, or what do you just believe like should people take away for like finding edge?
Yeah, the whole terminology of edge is like really, really disputed about what edge is. Like, I think edge is just your ability to make money on average over time, whereas some people think edge is only if you have alpha that not everybody else has. But I think there's pretty much two types. There's like a risk premium type that's pretty much a crappy edge, but works over time. And then you've got like your alpha that is something that could decay and just stop working, whereas a risk premium usually works almost forever. So stuff like futures trend following will be a risk premium that you can just run pretty much forever, but its profile of having drawdowns and everything like that is not perfect. But you can run it as your baseline, then you can put more things on top that might be less robust and might change. So if you've got, say, your shorting strategy that works since 2020 for a certain regime, if you're running that as just like the top 10% of your system, then if that stops working and you've got other more robust stuff that can continue working, that's going to buffer any system that fails over time. So I try and build these crappy little risk premium strategies at the base, make them a bit larger. So for futures, I've got trend following, I've got carry, I've got mean reversion, and I've got something called skew. And I'm also using seasonality data. So it's mostly based on price, or almost everything's based on price.
So a lot of your systems respond to like price behavior. So like a technical kind of thing, right?
Yeah.
Okay. And then, so with that being said, you briefly talked about the risk premium and the alpha approach, right? So has that changed? You said you now kind of have like, I guess, more risk premium approaches because they might last longer, versus kind of like the crappy edge that might decay over time. Like, what pushed you towards that? I guess that understanding of the two different types of edge, I would say.
I think influence from other traders, like having daily discussions with other trend followers. Like, I'm not a quant. I don't have a math background or anything. Right. I'm just a techie programmer guy. So, but talking to other traders who are better at maths and stats than me can help me understand that kind of thing. Okay.
And you said you're more like a techie guy. What exactly does I guess that background look like? That you work in a certain field that kind of taught you kind of the techie stuff, or is it just like a natural talent?
So I was doing programming and integration, so C++, Visual Basic, all that stuff.
Okay.
So the actual, that definitely helped with the programming part, but engineers often try to like over engineer a system. So there's probably more risk that I'll curve fit something than someone from a maths and stats background.
Okay. So do you think like that experience in kind of like you said, the being able to program, you think that is a necessary step to being a systematic trader, or you think it's a hurdle that it's going to be a hard hurdle to cover? Like what are your thoughts about, not being a programmer and trying to be systematic in general?
Yeah, I think there's definitely ways if you're not a programmer. I was talking to a guy yesterday who wasn't a programmer, who built his full system in C++. And C++ is one of the more difficult languages to learn. So I was kind of surprised he went for that. Like you could go for Python or something. But you have AI as well these days, and you've used real test, right? The actual
Yeah.
coding is really, I consider it really easy. So
Yeah.
it's just a matter of how much you're willing to commit in terms of time.
Yeah. And for I mean, I guess I can speak here for a second. For me, like I can program. I'm an engineer, right? So I have like I can't program. I can code math. That's what I can do. And I would say real tests, if you're used to TC2000 or TradingView, real test is like making a scan in one of those programs. Like as far as language goes, it's a lot of math operations. So it's not like you have to fully know Python or C++ or C# or something. Okay.
Right.
But
it's not procedural.
Yeah, I'm sorry.
It's not procedural. You don't have to write functions and things. So
yeah,
it's mostly just statements.
Exactly, which I can do that. I feel like if you put enough effort, pretty much everyone should be able to do that with enough effort, especially with AI. It's not too complicated. Okay, yep. So I guess let's start building out your systems, right? So you built a trading operation that spans over multiple markets, instruments, and strategy types. How do you describe how you trade today?
So, as I was saying before, mostly focused on longer term, and only recently I've added more stocks in because the reason I got rid of stocks in the first place is I didn't want to give up my discretionary oversight. So I used to add every single position into the quote monitor and watch the watch list every day and everything. But since I've gotten used to it, I'm now happy to let the stocks run their orders and do their thing without actually watching them. I'll just look like what were the trades that happened. And Realtest has a thing where you can take your trades CSV file and play it back. So I can just watch what happens afterwards.
Yeah.
So the futures, I still like add all the futures to the watch list, and they're all long term, so that's not as much work.
Okay, so when you say like you add them to the watch list, you're saying it's not exactly all automated?
It's all automated, but I just want to see what's happening, make sure all the stop losses are there and everything. So I can click on any future position, and then I can see interactive brokers, I can see the chart, I can see where the stop is. And you can learn things as well. You can learn like, what happens when a stop loss gets moved up. Is it better to move up from the close price, or is it better to move up from the low? And then you have to test that, of course.
Right. Okay. And then I guess, can you go over the markets you trade? Okay, because I know it's a lot.
Yes.
You don't have to like do all of them because it's way too many to cover. But can you just give like a quick rundown?
Yeah, I don't think it's that many because you guys are shorting stocks. You're using probably all stocks, all small caps. There's a lot of small caps out there. But for the stocks, I just stick to the top 1,000, like Russell 1000, NASDAQ, and S&P. Mostly because they work better on the long side for mean reversion. And secondly, because I want to limit how much data I'm running to keep things running fast. For the futures, it's about 125 different markets. So probably like 40, 50% might be from the US, then maybe 30% from Europe, and then a bunch of those from Asia as well.
Okay.
So I think with the futures, there's a common practice in trend following to diversify, take as many markets as you can. But what happens is you have a lot more indices and bonds than anything else. So you have to kind of size those a little bit smaller Otherwise, you'll end up very indices focused.
Okay. Yeah, I that makes sense. So since you trade, I guess, global markets on futures, have you looked at trading like global markets on, I guess, for example, stocks? Like maybe you take, I don't know, maybe it's the top 100 Australian stocks, trying to,
Yeah.
I guess, copy and paste your strategy over to other markets.
Yeah, that's actually part of the robustness testing, is to run the same strategy on different markets, make sure it just doesn't lose a bunch of money. So Norgate data has Australian stocks and they have Canadian stocks.
Mm-hmm.
So if you pay extra for those, you can get those. The Australian markets are a bit crap because we don't have a proper opening closing option, and like outside the top 100, the liquidity is pretty thin. So I don't trade them anymore, but also the time zone, because when I run my orders, when daylight savings is on, it's sort of just after the Australian stock market opens. So I kind of avoid that just due to the hassle.
No, that makes sense. I didn't. No open and no close. So you used to trade it, but you kind of dropped it, and that was once again kind of was it just because it just wasn't, you couldn't find like a profitable edge on it, or you just found other stuff to just be better?
Easier to trade the other stuff because there's more selection. So there's like with mean reversion, you can just run your orders and your limit orders on everything. But I prefer to be more selective. So I'll look at like the momentum of stocks and the trend. And then instead of taking like all of the Russell 1000, I'll take the top 300 or something that have the best momentum and then only run it on them. But for Australia, like you might only have 150 that are pretty liquid. So often on daily bars, you want to exit on the open because that's the closest to your signal. But the open is lower liquidity than the close. So that's why we have an issue trying to trade Australia. I could probably do it and account for more slippage, but because I'm futures focused, I don't want to get too crazy on the stocks. Maybe later.
Okay, that makes sense. So as you said, you're future focused, but you said you started off with crypto, but so what happened for that transition from crypto to futures?
Yeah, so with crypto, I was running nodes and getting involved in Ethereum and stuff. But what happened is crypto went into all the creation of new coins, like 5,000 coins a day and scams and everything. And I was it wasn't like my first cycle where I was a true believer in everything, but there was a couple of projects that had real world use, like Ethereum. And the market just wasn't interested in them at all. So I had to like trade out of Ethereum and trade more Solana, trade all this other stuff. But yeah, I didn't see the ability to have any sort of long-term investments. And the thing with Bitcoin, like selling out of Bitcoin over a year ago, I saw $100,000 as like close to the ceiling. So
really?
after that, the liquidity of Bitcoin is pretty high now. So if Bitcoin did another 10x, then Michael Saylor would be like the richest man in the world, control so much wealth, which I don't really see that happening soon.
Okay. That's most people you talk to, especially that have traded crypto, they really strong believers in that kind of thing. This is probably one of the first times I heard someone say like, yeah, Bitcoin's at the top. Okay. All right. Interesting.
It'll still go up, but I think it's going to be slow. Like you could have bought gold and gold would do better.
Gold is doing better right now. That's for sure.
Yeah.
So let's start talking about like your process, the back testing. Oh, actually, let's take a step back here. I'm relatively unknowledgeable about futures. I know enough that I can understand, but I've never experienced it. I've never traded it. So when you're talking about, I understand what a mean reversion is. I understand what the contracts are for like the trends and stuff. But when you're talking about stuff like skews and stuff like that, I'm completely lost. Can you give us a breakdown of the systems that you trade in futures and what they really, I guess in like simple terms, what they mean, I guess?
Yeah. So trend following, all of these systems could be run on stocks as well. So trend following is basically identifying if there is a trend, like the moving averages are going up, the price is going up. If you're looking at a chart, it's like higher highs, higher lows, and the reverse for shorts. So you just want to get in once you're confident that there is a trend. You set a trailing stop, and then you hold it as long as the trend stays. So in my system, I have trend following kind of merged with a seasonality trade. So I generate some seasonality indexes, and if the seasonality is not really bad, then it will take the trend position as well. And that's kind of a way to reduce the number of positions, because 125 markets, if I took every single breakout, then I'd end up having way too many positions, too much leverage.
Okay. And when you say breakouts, I'm sure there's going to be a lot of people who think discretionary based on like some type of pattern is that kind of how you're looking at them?
Yeah, it's not too different. It's like a Donchian or a Keltner or a Bollinger breakout.
Okay. Okay. Gotcha.
So it's pretty common with trend following. I guess there's two types. There's a type that uses moving averages and then measures the distance between them. And then there's a type that might use moving average just as a filter and then look at the breakout as well.
Okay. And which one do you take for your approach?
So I check the moving average for the trend, and then I'll enter only on the breakout. So I want to have it pretty strict, just so I don't enter too many times. So each market might only trade 3 times a year, something like that. So every kind of test is run on the whole lot of the markets at the same time. So I don't do any like specific rules for cocoa, specific rules for silver. It's all like the same rules, because to get enough stats in the back test, you need to treat them all the same.
Okay. So then for the seasonality index, which I think this is a key part to how you're trading these trends. How are you developing them, and are they individual for each? I mean, I would imagine they'll be individual for each market, but that seemed 120 markets. That's a lot. That's a lot of work.
It's it's a big area. There's lots of different things you can do, but mine is simply based on history. So you take 40 years of data. What's the average move between today and tomorrow? What's the average move between today and end of the week? And then from those, you can create like a pattern. So it's either going up on average over the next 3 months, or it's going down on average, or it's flat. So if it's normally going to go down in the next few months, I might delay the entry unless it has a really strong breakout. So I kind of combine the strength of the breakout and the strength of the season. And if it's really strong seasonally, I'll take like a weaker breakout. Or if it's a really strong breakout, I'll take a weaker seasonality. And this is something I did with trend, because trend following basically is pretty crap strategy on its own. And because I was going to run it with other things, I don't mind if it doesn't take a huge number of trades.
Okay. The interesting approach. So it sounds like a lot of
it's pretty unique
price action built into the seasonality. I guess I was, but I guess
price.
Yeah. Okay. So cool. So let's get into how your, I guess I would say, back testing some of these things, right? So when you find an ideal and you're like, okay, I'm going to take it to real test, what kind of puts you on to that ideal? Is it like you're looking at the screen? Because obviously, like you said, you live in Australia, is a different time zone. Like, how are you getting the ideals to even start the back testing?
Yeah, I try to take older ideas that are already sort of working. So if you see a paper and it was released 5 years ago, you can check, did that strategy work since the paper was released? So you've got like an out of sample there already. So I don't have a lot of maths and stats background. I'll try and minimize overfitting, but if you can take something that's working out of sample, or something that's worked for a long time, like trend following, and don't make it specific to specific markets and things, you're less likely to have overfitting problems, and keep the number of rules pretty small.
Yep, agreed.
But mostly from papers, from Substack, Twitter, from podcasts, sometimes YouTube, but sometimes from friends, like what friends are trading and have mentioned. Then I'll mention ideas to them and collaborate.
Okay, so you're like you're. It's not so much okay, yeah. So you're not so much sitting in front of like the computer and figuring out everything on your own. You're like scouring the internet. You're using all the resources around you to kind of build this edge.
Yeah, I don't want to sort of look at price action and try and make up stuff that I could potentially curve fit. Of course, I'll test stuff and make sure it's fine, and maybe change some things, but I don't want to have like rules like 2 up days, 1 down day, then it moves like this percentage off here and things like that.
Yeah, I got you. Okay, so and then you don't do shorts at all. Like, I mean, not you don't do shorts at all, but you don't do like you don't do like small cap stuff at all. So what kind of,
not small caps, yeah.
Is that something you like? What, I guess, what's the reason behind that so far?
GameStop and all the short squeezes. So the thing is with the shorts, normally you want to keep them like 1%, 2% of your account, and for a small cap, probably less. But I don't actually have the data loaded for the small caps either. But even with the large caps, there's still like a potential, very small chance that they could triple, go up 10x overnight, but it's pretty small. But a small cap, that can definitely happen. And even if you're intraday, if you get like a trading halt, then you can't get out, and until how long, you don't know.
Okay, so like the idea of like a black swan event or blow up is kind of what pushes you away from that. Yeah,
so I'm trying to build a system I can trade forever, for like 40 years, 20 years or whatever. Something I don't have to worry about. I take on a risk in terms of leverage, but I don't want to take on a risk in terms of stuff that's more possible than just general drawdowns.
Makes sense to me. And have you always been like this cautious, or did you get to a certain like I guess like a account size and you were like, I'm done. I'm not dealing with this type of, I guess, crypto scams and kind of these risky, trading activities anymore?
I think you're the first person that's called me cautious, because I'm normally pretty highly leveraged and stuff. Like crypto, I've had 70-80% drawdowns before, especially that first cycle. So and this first trend following system, I had a 30% drawdown. It's recovered now and gone back up way past it. But it's looking at like the volatility, annual volatility, it's a lot higher than what most people want to run. But yeah, definitely my age and having kids makes me not want to do too much stupid stuff, and so out of crypto.
Yeah. All right. I mean, that makes perfect sense to me. It goes back to kind of what you said earlier in the shows, the lifestyle of things influence your trading a lot. So, okay. So let's get into the real test. What are you using to test these futures, and what are you using to test these stocks?
So it's all real test. So real test had a little bit of futures at the start, and then they got CSI data integration. So CSI has a special thing where they give you the expiry date in a back adjusted series. So Marsden from real test integrated that. So instead of having to program all the individual roles and all the individual months, you could just take the whole long back adjusted series, and it could produce orders. It could connect to the API, send the orders in, and know the right contract from the CSI data. It's kind of like an integration between CSI and real test that makes it really easy. And that's something Marsden was good enough to develop for like the 3 futures traders that are on real test, just for a couple of us at the time. And then I was able to submit a lot of issues and work with him to get plenty of stuff fixed. And so now it's a really capable futures trading platform.
Okay, wow. So it sounds like, I mean, if I understood right, you can actually send your orders off from there, and it can.
Yeah, everything's from Realtest. So Realtest has a second app that connects to Interactive Brokers.
Mm-hmm.
So you run the orders in Realtest, you get like a CSV file, and then you run the order clerk application that connects to Interactive Brokers,
Mm-hmm.
and that will send your orders into the API. So I can do like a single button press, or it could be 100% automated if I wanted. And that single press will send all my stock orders, all my futures orders for the same day.
Okay.
That's another reason I don't want to do Australia, because then I have to do it twice a day instead of once a day.
Gotcha. Okay. And then you're what I mean, Norgate's all daily data, so that goes along with kind of like the the stock trending systems that you're trading.
Mm-hmm.
Which is you said trend following and mean reversions is mainly what you're doing with stocks right now, right?
That's with futures. With stocks, it's mostly just mean reversion.
Okay.
There's a couple of ETF things, like I trade the VIX ETFs.
Mhm.
That's a bit different. It's more. That's probably the only system I have that trades like a single market. It's because I did a course from someone who traded the VIX for like since it was started. He gave a lot of information on where the edges lie in VIX, so that was pretty good.
Okay. Yeah, I know a couple of people who, not necessarily long traders, but are more long-term traders. They have systems that trade the VIX at certain different levels and stuff like that. I haven't really looked into it too much, but it seems to be pretty common strategy. Or I don't know if it works for a lot of
It's
people,
got
but
like
it seems to be pretty popular. Yeah.
scary reputation as being risky. You short the VIX, it could go up a lot, but I don't think it's any more risky than shorting stocks. Like shorting an individual stock can go up more than the VIX. Like the VXX ETF, like the largest single daily spike was 40%, but like a single stock can go up 5x or something like that.
Yeah, for sure. So my next question, you talked about your drawdowns here, right? And you said you lost 80% when you first got started. But you also said you lost, you took drawdowns of like 30%, or 30% and more, on the trend trading stuff. So with that being said, what does your metrics usually look like? A drawdown of 30%, is that accounted for when you're doing your back testing and you're looking at your future system? Is that kind of already written in there?
Yeah, so the backtest allows for like 40%.
It's a decent
so
amount.
I kind of expected more than that eventually, but the common thing with trend following this year among all the CTAs is it's like one of the worst years in history. So there's a famous trend trader called Mulvaney. He had something like a 60% drawdown this year, but he's had some years in the past where he's made like 100% for the year. So a lot of the trend following drawdowns, they come from your gains because you have really wide stops. So like he might have made 100% in the last 2 years, and then the 60% drawdown is giving back some of the profit, just because you allow things to move around a lot. But in my case, it was mostly because I was running just trend. So I don't want to run just trend anymore, because if I did, this year would be only making 5% or something. And some years could be a losing year. Whereas running multiple strategies, then like for the financial year in Australia, starting in July, it's making a huge amount of money. For the US January to December year, it's making about 20 to 25%, which I'm pretty happy with coming out of the drawdown.
I would say 25% is good. Isn't that above the benchmark already? Just right there. So I would say that's pretty good.
There's kind of two benchmarks. There's a CTA benchmark, which is the commodity trading advisors, and their benchmark's pretty low. They don't have much volatility. They have big drawdowns, but they don't target a lot of leverage. So it's easy to beat their benchmark. But the S&P is very strong index. So it's hard to beat that normally.
Yep. So I guess with what all that you have going on, how long have you been, I guess, consistently profitable? Do you ever have off years? And I guess can you give like a number of the percent gain that you're typically targeting per year? Like what would be like a good year to hit?
Yeah, so with because I haven't done this long enough, and all my other strategies only started middle of this year.
Mm-hmm.
So I know since I put the other strategies live that from the bottom of the drawdown, it's like plus 90% or something. But it's such a short period, I cannot project that out into the future.
Mm-hmm.
And then in terms of the back test, I look at the volatility and sort of plan how much I can handle in terms of the risk moving up and down. But I don't really accept the return on investment as being that predictive. Like the back test could show, 70%, 50% or something. But if all those strategies worked better in the past because markets were less efficient, then I might not get that in the future. So like I was saying before, it's the market that makes the money, not the actual entries and exits. So I just target the volatility I want, which is like about 27 to 30% a year, maybe like 1.5 to 2% per day, up and down. Then if the market's going to make money, it will make money within the range that I can accept for the risk. So I'd like to make 50% a year or something like that. But the truth is, the way the market works, you might have a 0% year, then you might have a 100% year, mm-hmm. You might have a 10% or something like that. So it's just going to go up and down, and you won't really know your average performance until like 10 years later or something. So
okay, go ahead.
So I'm hoping for more than 25% next year. But we'll see how we go. Although in Australia we do July to June, so based on how it is so far, I'll probably have to pay a bit of tax this year.
Nice. I mean, that's not nice, but that's a good problem. That's a problem, right? That's a good problem to have. Yeah. Still rather not have the problem, but it's better than that than gain nothing. So you talked about the the market's not as inefficient as it used to be. So do you think this is moving forward in the next couple of years that as the market gets wiser, as things get, I guess, more systematic, or I guess more efficient, to just put it simple, right? You think this takes away from how much you can make off trading trends?
The thing is that I just know that I don't know. So it's possible. I think the efficiency affects stocks more. We used to have to pay a lot more commissions. If you back test like before 2000, people making phone calls and things to place trades.
Mm-hmm.
So there's a lot less systematic stuff back then. So I don't really know which edges will get decayed, but I think the longer term stuff is more robust because your trading costs are less. So if your profit factor is 2 or 3 or 4, then if your trading costs are like 0.2 of that, it's going to decay from the trading costs a little bit. And then if the edge decays a little bit, you've still got something there. But if your profit factor is like 1 or 1.1, then you've got much less space to have any issues.
Yeah. Okay. And then you talked about this briefly, but the metrics that you get from, I guess, like the annual return that you'll get from some year in trending, you don't really look at that as the forecast of what you should be doing per se, because the inefficiencies of the market, and the market can, the trends, it's the trends, right? It's some years it's going to trend well. So, go ahead.
Yeah, a few reasons. I mean, there's always a chance I've overfit something as well. And there's other things happening, like 24-hour trading is about to start. So I don't know if that's going to affect stocks. There's still like open and closing options and things, but say a lot of the volume moved out of the the daily session and into the after hours session, and then the behavior that we know causes the effect that might change. So from talking to other people smarter than me, I've learned that your back test doesn't really predict how much you're going to make. It more like predicts how much things are going to move and how much risk you're going to have. And actually similar for drawdowns, I don't believe backtest drawdowns the same way as returns, because the drawdown's just one point in time, right? So if you target a specific drawdown and you've only got like 10 years of data or something, then if you actually looked 100 years, you're probably going to see double the drawdown or something. So it's a little bit risky to focus on return and drawdown, but it's what a lot of people go straight to.
Yeah, I mean, I think those are some of the most important metrics for most systematic traders. It's like that drawdown. They believe heavy in. If someone sees a 50% drawdown, a lot of people are throwing that system out the window.
I think it's okay in that direction. Yeah, I think you can use it as a negative test to throw something out, but I don't think you can look at a 5% drawdown and say that's safe. I think if you follow a volatility, if you've got like 70% volatility, but 5% drawdown, then something weird is happening there, and that volatility is predicting a much bigger drawdown.
Yeah, I would typically agree. There's probably some overfitting. You place your stops too small compared to what you're actually back testing. I mean, there's probably something wrong with that.
Or anything,
yeah, exactly. Okay, so sounds like you have a good amount of experience back testing. I mean, you're talking about kind of some of the, I guess, the issues that a lot of people see when they're back testing. Like you said, that 5% drawdown, but 70% volatility. That doesn't make sense. Can you tell me briefly about, like, I guess an experience, like a learning experience where you might have overfit, or you just pretty much just BS the back test and it just lied to you?
Yeah, I was reading something the other day it was on Twitter, about a breakout strategy. You buy a breakout when it hits a certain level. I think it's the high of the previous day. And then you sell at a certain level above that. He did have intraday data, but I thought I'll test it on daily. So I put it in with a stop entry. So as soon as it hits the high, that's where the stop price is. You buy it, then you sell after a certain point. And I turn the logs on, and I could see that it's making assumptions. So it's assuming which order the stop loss happened and the stop entry happened. So with daily bars, there's like an ambiguity. It has to make an assumption. If the high is higher than the low, if the high is higher than the open, then it has to assume, which order they happened in. But it could happen in reverse. So the back test is kind of very unreliable.
Yep. I had the same experience in real tests. And then because of that, I had switched to Amni Broker. Yeah, exactly what you're describing. I wanted to test a breakout strategy, and I seen that the assumptions of the time orders was wrong for multiple breakouts that I have taken. It would say I was entering, I would stay in the stock, but what happened was after I took the high, the low didn't happen, and I should have got stopped out, but it kept going because it assumed the wrong order. Exactly what you're talking about. I went through that same thing.
Yeah. You can change the assumption, but basically it's still an assumption. You don't know.
Yeah.
And the solution, if you're using real tests, is just to not do that strategy. Just I'll make it multi-day, right? Like,
yeah.
You put stops on. I'll put like a rule that it's already been held for the first bar, so the stop will happen on the second day. But for stocks, I don't usually use stops at all, except for shorts. So I'll put like a stop 50% above the price, just in case something crazy happens. But in the back test, it doesn't get hit because not many large caps do that.
Yeah. One of the previous the previous guest, and that episode will be coming out soon, he said that you can really tell if something's robust if you get rid of the stop and test it, and it still has edge. And that was a shocker to me, but it actually made a lot of sense after he explained it, exactly what you just said. So yeah, nice. So
that's how I build as well. Actually, I build everything without stops, and with like more lenient rules to try and take as many trades as possible.
Mm-hmm.
So like easier breakouts or easier entries. So if it's going to be like 200 trades a year, I'll try and build it with 400, and then after it looks robust, then I'll filter down and cut out some trades.
Nice. That's exactly what he said is a proper way to backtest. So sounds like you have a good methodology of backtesting here. So sounds like the people that you're working with. Yeah. I mean, everyone has a ways to go, right? We can all get better, but sounds like you're well on your way for someone who, I mean, well, you said you've been backtesting for a while, but you kind of started doing stocks recently.
Yeah, I was talking to some other people about and reading some stuff. There's a better way to do it, to try and use like statistical tools to measure the effect that you think your edge is based on. So not backtesters, using things like scatter plots and other statistical tools to figure out if your edge is real, and then compare it to the inverse, compare it to buy and hold, things like that. And actually do your research totally separate to the backtester. That's something I need to figure out.
That sounds very interesting, maybe slightly complex.
It is. It does look complex,
so it's like multiple execution strategies to kind of, like instead of just sell on day one, you might hold longer. Is that kind of like the ideal?
It's more like figuring out what's supposed to happen when you're in the trade. Is that going to happen, and not be specific about your entries, exits, and things like that. So if you think the S&P is meant to go up at the end of the month, if it went down at the start of the month because fund managers are rebalancing their 60-40, then you can like look at the stats, how that happens across all of the days, individual days, and you can do a scatter plot, compare that between SPY and TLT, and just run like general statistic stuff. So I don't have a maths background, so it's something I should learn, but that can all be done first before you backtest. Because if you just backtest, you might be like specifically picking certain days, but it could be some other effect that's causing it.
Okay, I get what you're saying. It's more like doing statistical analysis before you really dive deep to kind of get the data set that you really, really want that's actually going to be good.
Yeah.
Okay.
Yeah.
Okay. So let's talk about some metrics here. You briefly mentioned profit factor. What type of metrics are you using when you're doing these back tests and real tests?
Yeah. So when I'm building, I'm looking at profit factor. For futures, percentages don't really make sense, because if you've got things like interest rates, the interest rate price is just 100 minus the rate. So if you calculate the notional value, it could be $1 million for one contract or something ridiculous. So you can't really say I made a certain percent. You have to do it based on ATR or based on volatility. So like if I use expectancy with futures, I'll look at the ATR expectancy. And then for stocks, Realtest lets you customize the metrics. So I use a percentage expectancy for stocks, and want to have like at least a minimum amount there that's as good as the other strategies.
Okay.
Profit factor, also volatility is a big one. So I'll look at like the 10-year volatility, the volatility across the whole back test. So I want my like 10-year volatility of the portfolio to be below a certain amount. For building an individual strategy, it could be anything, because I can just adjust the leverage to change it later.
Okay. Have you ever looked at, like, for the volatility, like a Monte Carlo kind of simulation type of thing?
Yeah, so Realtest has one built in. It's probably not the best. Like I was saying with the statistical tests, this is something else I could improve in, like running separate robustness tests outside Realtest.
Yeah. I kind of like the Monte Carlo simulation. Some people think it's BS, but I think it gives a good expectancy of like what type of bands you can produce. So like it kind of shows like the volatility on the graph, kind of in a way.
Yeah.
So just representing numbers, it represents like an equity curve in a kind of way. It shows like, hey, if your stuff's pretty wild, then you can your drawdowns can get crazy. Like I guess the general visuals of it shows to me like similar what you get in an equity curve, right? So you get a better understanding of what you're dealing with by how
It's a
separate the bands are.
pretty broad term as well. Like the one in real test, it just takes like the top 5% and bottom 5% of trades and runs the equity curve. So if it had the worst trades, then you're going to see like if you only happen to pick the bottom 5%, is it going to go negative? Stuff like that.
That's also, I mean, that's a good limit test right there, though, in a way, But yeah. Okay, so those are the metrics that you're using. And we already talked about like the tools. The main tool that you use is real test. Have you really used anything else outside of real test? Have you tried anything?
Yeah, so for operations like just running the daily integrations, I use Python. So Python will run on the Windows scheduler. But both of the data tools like Norgate and CSI you can call from command line. So it will call those to do the download. CSI will say when it's ready. Norgate's normally always ready, but I'll like output a CSV and check the date. Then it will automatically import into real test, run the orders in real test, take a backup, zip the orders and things like that. I'll create like a text report so I can see everything laid out as I want it. It also tells me if I need to roll any futures contracts. So something is about to expire, I need to like close that and open the next one. So that part is manual, because if you trade those with a spread order, which is like buying and selling exactly the same time, that can save on costs. Then there's like the orders tool. It will open that, load the orders, it synchronizes what the fills were. And if I like everything, I just push a button. So that's pretty much all Python that connects everything.
No, nice. That's a great flow to have, right? I would appreciate something like that. And I think IB and real test being kind of integrated is really nice. Do you have any recommendations for someone who's, I guess, looking for more of like a daily strategy type of style trading like you have going on? What do you? I'm assuming real test is your go-to. Have you looked at anything else though that for like a beginner that they might be interested in using?
People have talked about SQX, Strategy Quant X. You can just drag and drop things. But from what I've seen of it, and I've talked to people who've used it, the way it builds strategies and optimizes really encourages curve fitting. It sort of shows like when you build something, it'll say, okay, here's 1,000 possible strategies from this setup. And then they could pick the best strategy that's like, best parameters or something. But I think real test is pretty simple. And with stocks, you can do short-term, long-term. You can do trend following, momentum, mean reversion. You can still get like a diversified portfolio, even if the stocks themselves are like pretty correlated. But stocks for trading, I think, is a bit easier than futures. But once you are trading them, they have some annoyances like corporate action, splits, and dividends and things to worry about. Futures have the issue of like rolling contracts, but they never get delisted and they never get expired. And I mean, they expire, but they don't have corporate actions. Yeah.
I don't know much about futures, but yeah, it's just the splits and stuff for stocks obviously it can throw off a strategy. So I guess the automation you have is really just through kind of Python and IB, or Python real test IB, I should say, but
and the data, yeah.
So that makes it relatively simple. That probably, I guess, how long did it take you to build that system out? Doesn't sound like it was. Most of the stuff is kind of set up inside of the apps you're using, right?
Yeah. So the automation Python just connects things, and everything runs from the command line. So you can do it in PowerShell or in a batch script if you wanted to. And real test comes with like a sample that will do a simple orders run, a simple simple import orders and sending to the broker. But I actually did it when I was doing stocks only, and I did it fully automated. So it would just run the orders at a certain time, and it would send me an email with what happened. But now I think I'm complex enough that I want to make sure everything's good and doesn't take that long.
Oh, so you feel like it would be relatively simple for even someone like me who's not a developer but has some type of coding background. You think I can probably set that up relatively easy?
Yeah, I mean, you can take the sample script and connect up your own stuff, then just edit it. And I didn't build all of that myself after that. I just used the AI in Python.
Mm-hmm.
So it's Visual Studio Code, but now I've got Cursor, which it pretty much looks the same. Pretty much the same.
Yeah. That's what I have set up right now too. After talking to many people, cursors with Visual Studios it seems like what people are really gravitating towards in this space. So, so let's talk about the psychology. You talked about you had multiple drawdowns. What and especially what I think is interesting, you talked about your drawdowns. You also talked about how you look at backtests, right? Backtests are not so much a future representation of what can happen. It's more like, for you, it sounds like more like a litmus test where it's like, okay, this strategy has this much risk. I'm throwing it out the window. I don't want to deal with that. But if but it's not so much representation of what you can get live. So with that being said, when you're going through a drawdown, how do you kind of look at that drawdown and say, hey, I'm gonna keep this system running? Or how do you have that confidence to keep things moving forward?
Yeah, I think a lot of it comes to how you build it in the first place. Like using an old strategy that has worked in the past, has worked out of sample, different old ideas that still work. Like trend following, it's pretty hard to stuff up. So when I have the drawdown for liberation, everything got hit on the stops. So after that, my exposure is really low. So it's really hard for the drawdown to just keep going. So I might have had 40 positions before liberation, and afterwards maybe 10. So for that drawdown to keep going, your new positions have to trigger. So there needs to be a new trend. Maybe it's a downtrend. Then you have to enter those. Then that has to reverse. So for the drawdown to go really far, you have to actually get multiple reversals in a row in multiple uncorrelated markets. So bonds would have to reverse, stocks would have to reverse, metals, energies, everything. Then it'd have to reverse again. So the whole exiting and stop loss procedure kind of caps the drawdown. So I can see the risk from what's open at the time, but also you still do use drawdowns in the backtest. You look at them to know what's a normal behavior, and I do 40 years. So 40 years gives you a bit more. Yeah, a bit more examples. A lot of the futures contracts go back pretty far. So especially the commodities. Some of the indices are pretty new though.
Okay, so like for futures, and once again, my experience in futures is, I don't have any real experience with futures, but when you're back testing that, like 40 years of testing the stock would be, that would be a lot. That's like insane, right? Even like 20 years, I would say, is kind of you could be overdoing it.
Efficiency issues back then too. So
yeah,
like probably before 2005, like you could test any strategy and it looks amazing back then. So I wouldn't want to trade any stocks based on what they did back then. Yeah. Right.
Exactly. So with futures, the futures has, I guess, been around like for like the bigger guys, futures been around, and that's kind of been like a market that people have attacked to find edge in for a while. And it's probably a more efficient market as well. So you're saying the 40 years is like the min for you for like futures when you're testing?
40 years is like a max test just to see what happens.
Oh, but it's max. Okay.
I wouldn't look at 40 years to judge my volatility or anything like that, because what happens back then is there might be like a 1/3 of the amount of contracts available. So my position count could be less.
Mm-hmm.
So I'll have like a normal period of like 25 years back to 2000. And then that's like my combination to see if everything's combining together and how much the volatility is. Then mostly just the last 10 years, I'll look at the 10-year volatility. So it shouldn't change a lot between 10 years and the total. Then I run like a 40-year test just to see, if I've overfit something and it's going to just totally destroy itself in out of sample. But most out of sample testing I do is when I build the individual strategy. So I'll use like a single period to build it.
Yep.
Then I'll like test before and after.
Yep.
So see what happens before that, see what happens after that.
Yeah. Okay, I was just gonna say, just so people can understand what you're saying, is like maybe you have a strategy and you test it. Maybe you built a test on from 2010 to 2020, right? And then you'll test it before 2020. I mean, before 2010 and after 2020 to see the robustness and see if it still gets. Now, when you do that, because according to what you're saying, you're like, it's not necessarily a representation of the future. Now, when you're doing your out of sample, are you just testing to see if it's still positive? It still has like a drawdown you're okay with, or are you testing to see if it's like accurate to what happened in the in sample testing?
Yeah, it probably decays a little bit, but you don't want to see like a massive change. Like some strategies you get, and someone's even posted the code or something online. You try them out in the period they've given, and then you try them in a period that they didn't give, and then all the gains are just gone. So just be careful about things like that. But in terms of like the metrics, it's not that scientific. Like I don't think you can pick a single metric or a couple of metrics. You've got to, that's the discretionary part, I think, is use your experience to kind of judge what you think is good, what you think isn't. And stuff I built in 2024, what I thought was good then was doing a lot of trades, doing smaller caps, mean reversion in Canada, mean reversion in Australia, things like that. And what metrics I thought was good then are totally different to what I thought was good now. So you're going to like evolve over time what you're going to use.
Yeah, that makes sense. I know people who, when they first started testing, they looked at something like a percent change to be the best. And now obviously percent change is relative to volatility or your average true range and other things. So yeah, that makes sense. You definitely evolve as you go, which brings me to my next question. What's been the biggest shift in your mentality through the years of trading?
Well, shifting to systematic is one, but then since I've gone systematic, it's only been like almost 2 years, but it feels like a lot longer. So in that period, I've had quite a lot of shifts. So I've looked at like short term, I've looked at low liquidity, then I've moved to high liquidity, long term. Probably the other things I was saying, like shifting to looking at volatility instead of looking at like return versus drawdown.
Yeah.
And using Sharpe ratio, like a lot of people, and I kind of agree with some of it, that the Sharpe ratio is not ideal because the highest Sharpe ratio strategies blow up a lot because they don't have the drawdowns in the backtest. But the reverse can be true as well. Like if you just look at pure return, you could have a high return just due to leverage, right? Whereas Sharpe ratio is like in relation to the leverage. So you could have like a fairly good Sharpe and then just adjust the leverage to get to where you want.
Yeah, and I think that's kind of one of the things I would like to capture here is like I consider that's like an advanced metric, like a Sharpe ratio. And I would say Monte Carlo simulation is also advanced metric. Maybe Kelly criteria is advanced metric that people use. And I'm just I would like to grasp why people are using them and how they're using them. I think some of those things, obviously they're very complex at the ideal in, I guess the ideology behind it is rather complex and the math behind it can be complex too. But I think they have some good uses that, like you said, with the Sharpe ratio that you can use to grasp what's really going on.
Yeah, I think the way I do it in the portfolio is a bit different to strategies. Like strategies, I'll look at profit factor to make sure each trade is going to make enough money. But then when you combine things in a portfolio, the Sharpe ratio actually tells you, is the new strategy different to your existing portfolio. So if you have a short selling strategy and you build a new one and it looks great, then you add it to your portfolio with your existing strategy and the Sharpe ratio goes down, that tells you that your new system is actually not any different. It's actually probably even worse, but the correlation is probably going to be 1 or something.
Yeah, there would be a strong correlation there. I guess this is an interesting question. What took you like the longest to learn, like in trading? Like what was like one of the hardest things for you to learn?
That's a hard question.
Yeah, I was trying to think about it for myself.
Yeah, I guess there's no one thing. It's just sort of evolved slowly over time. But I'll tell you one thing though, it just depends on how much time you put in. So how much motivation you have. Once you go into drawdown, that is the best thing to spur your motivation. So once I hit the trend following drawdown and I knew I wanted other strategies, I might have taken like a year to finally get into it. But as soon as that was there, I was suddenly building strategies. I was suddenly doing all the other to do. I was like, this drawdown sucks. I don't want to have this again. So
yeah. I think we need a term for that. I don't know what the term should be called, but that actually happens to a lot of people I talk to. The drawdown lights. The drawdown lights a fire.
Definitely.
And you know that's so weird because the psychology behind it, right, is like some people hit the drawdown and they fold, they quit, right, and then there's a lot of traders who come successful out of the drawdown. It really puts something, it puts like a flame to their ass, and they get up and they start working really hard to find what works, and they get way more serious. So it's like I feel like that moment is kind of what defines a lot of people's careers.
Yeah, I mean it's the same for everything, like, but
right,
you've got to like push through any problems to get to the other side.
Yeah. Okay, cool.
I think there's like a difference with the drawdown though. You got to be careful. Like if you get a drawdown and you're running one strategy, you shouldn't just focus on like keep improving that one strategy because you might just curve fit it. You got to use the drawdown to make you build other strategies to go with it, because it could be totally normal drawdown. And for trend following, like no matter what I would do, I think there'll always be a drawdown in liberation, and there was for everybody else that does trend following as well. So it's not something you would try and filter out.
Yeah, I would say trading makes you reinvent yourself a lot. Speaking about reinventing yourself, how long do your strategies usually last? Like I imagine the futures ones can go just forever. Seems like that's kind of been the general sense. Like future strategies don't really die that often.
Well,
has that been true?
There's two kind of futures traders. Like this is the daily bars that have the close using the settlement price. They're like more long-term strategies. But there's also people who trade intraday and using things like multi-charts, TradeStation. They're doing strategies on single markets. Like they might look at crude oil and say, crude oil going down 3 days in a row, I'm going to buy it and then sell it when it goes up and things like that. They'll build something, but then they have to really watch it for when it stops working. And, Kevin Davey, have you seen Kevin Davey?
No.
He's like, he won a trading competition and he sells books and does some training on how to build those. But he'll have he calls it a strategy factory where he builds out all these intraday future strategies and runs them. And then as they die off, he's replacing them. So it's there is like a section of futures trading that does decay like that.
Okay. So just like every other market. I don't know if I really know any, I guess, stock strategies that just run forever. I know mean reversion has been around since the existence of time, but they have been out of cycle and in cycle. So yeah. Okay. Yeah. So on the closing here, I got a couple of questions, and I want to apply them to you. You said you only been, I guess, really getting really active into the trading since like 2020, so around like 5 years, and you've seen some success doing that. rather decent success, multiple systems. How many systems do you have in total, would you say right now?
Depends if you consider the combined systems as one, or if you look at like the individual models, but it's probably around 20 to 30. You could just combine them and have maybe 15, 16 strategies.
Still a decent amount. And what do you say the ratio is for that?
About 60% futures, about 40% stocks, but not in terms of number, in terms of allocation. So I think the stock strategies is a much larger count of stock strategies. But like I was saying before about the volatility, you can look at how much each one has and then allocate based on that. So I want the futures to be more volatile. It has a lower Sharpe, but it's more robust. So I want to give it more money. The other problem with futures is some of the contracts are pretty big. So
yeah,
you need quite a bit of money to trade.
So you gotta have some type of capital to really invest into futures for some markets.
Yeah, I mean you can build with smaller capital if you use all the micros, but you still need, if you're going to do trend following with like a lot of markets, you still need probably at least 100,000, I think.
Okay. And so what has been the best resource so far? It sounds like Real Test, just from listening to you talk.
It's so fast. Like someone can say something on Twitter about, trade when this happens or whatever. And there's guys on Twitter that would just go and test it and say, yeah, it doesn't work. You can do it in 5 minutes, right? So yeah. It's a rapid development environment. You can just test things that you think or someone says might work, and then you don't have to waste any time on them if they just fail in 5 minutes, and just delete it.
Yeah. What advice do you have for, I guess, someone who is in a similar position to you? Maybe they don't want to really do like the shorts, or they're not trying to take all the risk premium, the blow ups and stuff like that. And they're looking for, I guess, not a safe style of trading, but something that's moderate and it's not going to have them, homeless outside because they lost their whole account. Right. What would you say to that person getting started?
I'd say trade less frequently, because whatever edge you have, like if you have less edge than you think, then your trading costs are just going to eat your profits. So if you're holding for a month or 2 months, your trading costs are going to be much, much lower. When you start out, you think like trading costs don't matter because I'm going to make, 5K from a good trade or whatever. But if you average it out and then you look at what's actually happening, the trading costs can eat into things. And commission's not the only cost, right? You've got your slippage, you got your spreads and things like that. So yeah, look at trading costs. If you're like me and you don't want to be risking too much in terms of strategies stopping working and stuff, just stay longer term. Longer term strategies tend to work for longer. And then I'd say don't focus on one strategy, wanting it to be, making money every year, every month, or anything like that. Like you see a lot of discretionary traders that if they want to be consistent, they say I want consistency, and they think they need to make money every week or every month. But with their strategy, they've only got one strategy. But some strategies go whole years without making money, or even 2 years, and it's still a good strategy. Like trend following on stocks could lose money for 2 years, then it could have a plus 100% year. So instead of doing that, just make multiple strategies and run them together.
That's actually really, really good advice. That's something I wish I would start off with, multiple strategies. And then for my closing questions here to wrap this up, what do you think? What characteristics do you believe really aided you on your journey so far?
Definitely having a tech background helped, but I've seen enough people without tech backgrounds do fine. If you have a maths background, statistics, that would definitely help as well. I think the characteristic that matters the most is being able to commit to something and not give up, because and not being too optimistic. Like if you think you're going to make a lot of money in your first year, I think you're just going to lose a lot of money because you end up over leveraging. Some people are the reverse. They're like too cautious and they'll just build and build for 2 years and won't take a trade. But just having that persistence, I think, is key. Just keep going until you solve everything. There'll be more problems, and then each time you just keep pushing and solve them.
Yeah. Consistency is key. That's what they always say, and it's true. And then what do you think, or what characteristics do you believe has been, I guess, the biggest hindrance to you in your trading journey, the systematic trading journey so far?
Probably my optimism. I'm very optimistic. So I, like, from my discretionary background and, a lot of luck involved, I have a tendency to want to take a lot of trades. So I want to trade a lot, different to people who are more risk averse. So I would, when I start out, I want the system to be trading a lot, but I learn over time it's better just to build the system that's going to be taking that effect the best way possible and just leave it. Probably like a psychological hindrance as well is like enjoying watching the markets. So if I watch the markets during liberation, I wake up in the middle of the night, check my phone, see a massive loss. It's like, it's kind of distracting, but I know not to touch it and just leave it. But if you can just ignore your systems overnight or whatever time of day they're running, it's going to be a lot easier. You spend a lot less time on it.
Okay. Yeah. I actually noticed, I was kind of shocked when you said you was talking about your trend trading strategy, and you said you had, you got stopped out at, you had 40 trades, you got stopped out at 30 of them, you had 10 left. I was like, 40, that's a lot. That's a lot to have on at one time, So I actually thought that was very interesting. Sounds like a aggressive trend trading strategy approach, but obviously if you're trading all the markets that you are. Yeah. So that makes sense.
Works on diversification. So you have to have, it's generally better to have a lot of small positions than a few big ones. Mm-hmm. So you have the ideal case where, stocks are going down, indices are going down, but, silver's going up like yesterday. So I've got indices and silver on together. Indices lost a little bit and metals made a punch.
Yeah. All right. Well, that's going to wrap up this episode with Dan here. I hope you guys learned a lot. I definitely learned a lot about futures. Maybe someday I'll jump into it myself. So once again, this is episode 6 of the Quant Room, hosted by Spikeet. So if you're interested, subscribe. We release episodes every Monday. Our goal is to bring you more information about systematic traders, their journeys, just getting the stories behind the data. So if that's something that interests you, each week, Monday, we should have a guest coming, dropping some knowledge that you can gain some information from. You got any last words?
No, it's all good.
Okay. Let's wrap it up and get out of here then.
Yeah.
Peace out, everyone. See you next time.
Cheers. See ya.